Okay, well then real briefly, I need to explain some of the basics of this thing here because there are several components of this and we'll be talking about them, we'll be using these names, and so I want you to get familiar with these. For those of you that are new, we're going to take a few minutes to describe those here, and then we're going to start to get into this indicator and talk about how we're going to apply it to trading. Now, all those components of what it was trying to do, it does that through a series of components within the indicator. Let's talk about that. The first line that I'm going to be referencing is this white line here. This is the Keygen line. So this line right here. The Keygen line is very simply, we take the last 9 candles of whatever time per run, we take the highest high, the lowest low, and over the last 9 periods, the absolute high and low over that, and we track price over that. Divide it by 2 and then shift it over 9 periods. And so it's kind of like a 9-period price action line. It's not like a 9 moving average. Moving averages are smooth. As you can see, there's nothing that's smoothed out on this. That makes it a little more sensitive to price. So when price makes an adjustment, the Keygen line often does it as well. The main focus of what the Keygen line does is twofold. First, it tracks momentum. It's often known as the momentum line, the datum line, the turning line. And so it's really trying to track momentum on a particular instrument. The second thing it does, as a typical turning line does, is that it's also trying to tell you when a turn or swing or trend is about to happen in a particular instrument. And so that's the other focus it does that. It does that by crossing with this line here, this red line called the Keygen line. The Keygen line is known as trend line or Keygen sen. And the main goal of the Keygen is to tell you what side or where the trend is at and if we're still in a trend and to contain the trend. Once it fails to contain the trend, then once the market fails to stay on one side of it, then generally that trend is over. And this is a very loose definition, just to give you the basic idea behind it. So the Keygen and the Keygen are really tracking the momentum and the trend, and they can perform what are called crossovers, or Keygen crossovers. When they do that, they can create generic bearish or bullish signals. The downward crossover is a generic bearish signal. An upward crossover, like this one, is a generic bullish signal. But the great thing that Goichi Asada did was that he was able to define the strength and likelihood of that crossover leading to a move based upon where this crossover is in relationship to the cloud. Is it below it? Is it inside of it? Is it above it? And that will increase the strength or weakness of that. Now, the thing in terms of determining future support and resistance is what this thing does, this blue thing, the Kumo. That's what it's designed to do. It's designed to give you support and resistance levels, and as you can see, it's changing in shape. Changing in shape, changing in thickness and thinness, trajectory, and that's because the market evolved. This is a very non-Western approach to the support and resistance. If you think of all the Western methods out there that have created support and resistance, let's take a look at them. Channels, trend lines, Fibonacci's, pivot points. They all look at it as a very straight line. That line could be angled, but it's still a line. So they tend to look at it from more of a mathematical perspective, a pure mathematical or pure linear perspective. Asada didn't believe support and resistance was purely linear. He believed that support and resistance was something that was evolving, and it was directly related to how the previous price action was behaving. He was very concerned with how price action moves, and that the price action should determine future support and resistance levels. Where price was and has been and how it's behaved should determine where the market will likely have problems with future support and resistance. And that's why this Kumo takes on different shapes and sizes and trajectories. Now, the Kumo has 2 small components, and then once I'm done describing the Kumo, you guys will have the basic language, and then we're going to start going how we apply it. We're going to start off with the dollar yen. The Kumo has 2 basic components to it. It has this white line here, which is called Senku Span A. We'll just call it Span A. Span A is the simple halfway point between the Tenkan and the Kijun. We take it in half, shoot it 26 time periods ahead, and that is your Senku span A. Senku span B, which is this blue part of the Kumo, is the last 52 candles. We take the high and the low, we divide that by 2, and we shoot that 26 time periods ahead. Now that's kind of important because what it's doing is it's constantly monitoring the range for the last 52 candles. Whether it's a 4-hour chart or a daily chart or whatever, it takes the last 52 candles and it says, look, these have a certain significance to price action. And so with that being said, we want to find out what the high and low is because that should tell us where future support and resistance is likely to be. And what it does, it takes that high and low, it cuts it right down the middle, and it projects that 26 time periods ahead. So my guess is that the high and the low of the last 52 candles probably reside somewhere between here and here. Somewhere between here and here. Depends. It could be here to here. You know, this is the high and this is the low. Somewhere around here. Now, the shading in between is merely just the space between the two values, and that becomes the Kumo. The Kumo itself is designed to represent support and resistance. And what that means is that this, if it's really thick, we are inside support and resistance right now. Currently, the dollar-yen is inside, on a 4-hour chart, is inside support and resistance. Generally, that's not the range that you want to be trading. Typical Ichimoku models will say, look, you don't want to trade inside the Kumo. You want to wait till you've either cleared support below it or you've cleared resistance above it. Inside there is a zone we don't want to trade in, and understandably so. Now, why is this formation interesting? Why am I looking at dollar-yen? I'm looking at dollar-yen for a very specific reason. For those of you that have been trading the Ichimoku Cloud or come in this class for a while, what do you think that reason is? The reason why I am monitoring this one here is because of this flat top. Now, why is a flat top significant? A flat top is significant for Ichimoku traders because of the following reasons. Remember what Senku span B is composed of. Senku span B is the halfway point for the last 52 candles. In other words, the halfway point of the range. In a range, let's just say the range is from here to here. Halfway point's probably somewhere around here. Close. Somewhere around there. Give or take. Now, in a range, if price is in a range for a long period of time, if price is spending a lot more time in the upper half of that range, it's generally got more bullish pressure than it does bearish pressure. However, if price is in the lower half of that range, it generally has more bearish pressure than it does bullish pressure. And so to Hosada, the main thing was, if price is on this half of it, then it's more likely to push to the upside. If it's on this half of the range, it's more likely to push to the downside. That was the intention behind the Senku span B, was to constantly track that. The thing about it is that this halfway point here, these flat tops happen when the market gets stuck in a range and the high and low value doesn't change as the candles progress on. Flat tops become significant because they represent the middle of a range. A middle of a range is also known as equilibrium. It's that halfway point where it's not in an oversold, it's not in an overbought, and the buyers and sellers are comfortable with the euro being on that price. So it becomes kind of like a magnet because it has a certain equilibrium for that particular price. What's interesting to note is that from this last high to the low, this flat top resides perfectly with the 50% Fibonacci. Now, instead of the market going to this 50% Fibonacci, selling off and coming back down just sub 8650, it didn't do that. It sold off very aggressively, and then it just kind of stopped. It just stopped here, got some good buying pressure on it, tried to sell off again, and then it just sat right here for 8 hours. Since then, over the last 12 hours, it's launched up, stopped here at the 38.2, and then opened and has now touched the 50% Fibonacci. Flat top Kumos become very, very significant because if they become broken, they often can signify a reversal and also a nice little entry point to get in it, because especially since the Fibonacci is matching up with it, if we break this Fibonacci in the flat top, then the market can use it as a future support level, roll reversal, to attack the upside. So flat tops are very, very useful. They're very, very powerful. They're more powerful on higher time frames such as the 4-hour dailies and weekly chart.